Do you ever look at trading charts and just feel completely confused? I mean, that tangled web of green and red candles can feel like an absolute maze. Well, let's jump right into today's deep dive analysis. We're not just going to talk about lines and shapes today. Actually, we're going to decode the real language the market is trying to speak to you. We are diving deep into candlestick psychology.
Now tell me honestly, are you tired of trying to memorize dozens of weird names? You know, stuff like bullish harami, shooting star, or engulfing. If so, I've got some great news for you. Memorizing those names does not make anyone a good trader. That is probably the biggest myth out there. The real secret doesn't lie in the names of the shapes, but in the market psychology hiding right behind them. If you can understand exactly what was happening between the buyers and the sellers during that specific hour or 15-minute window, you're literally never going to need to memorize a pattern name again.
So here's how we're going to break this whole battlefield down today. First, candlestick psychology. Second, the secret of long wicks. Third, understanding momentum. Fourth, inside and engulfing patterns. And fifth, the golden rules of trading.
All right, starting with part 1, candlestick psychology. We really need to shift how you view the market.
It's not just a graph bouncing up and down. It is an active, ongoing war between two very distinct armies. And what's absolutely fascinating is how this entire story boils down to just two words: supply and demand. Whenever you see the price falling, you need to understand that supply is dominating. Sellers are stronger and they're actively pushing the price down. But when the price goes up, it simply means demand has spiked. Buyers feel things are cheap and they're using all their strength to push the price higher.
So the absolutely crucial point here is that you have to stop memorizing what a candle looks like. Instead, ask yourself one simple question. While this candle was forming, who won, the buyer or the seller? Once you grasp that logic, that underlying buying and selling pressure, you're going to start reading charts like a seasoned pro.
Moving right along to part 2, the secret of long wicks. This is our very first visual clue.
That thin stick jutting out from the top or bottom of a candle, don't just see it as a line. Treat it as a literal battle scar left on the field. Imagine you're looking at a 1-hour chart. How exactly does that form? Let's say the market was dropping. The candle opens, and sellers use all their might to push the price way down. But suddenly, the buyers step in. They look at it and think, wow, this is incredibly cheap. They start buying aggressively, and within that exact same hour, they push the price all the way back up, closing it right near the opening price. That fierce struggle is what leaves that long wick trailing at the bottom. It represents a completely failed attack by the sellers who are ultimately overpowered.
And when you see multiple long wicks in a row, well, it has a very clear meaning. It means one side, let's say the sellers, is desperately trying to push the price down, but the buyers are fighting back with equal aggression every single time. An inverted or upside-down long wick tells the exact same story, just in the opposite direction. All of this tells us exactly where demand or supply is making a firm stand.
Okay, part 3, understanding momentum. Now that we can spot battle scars, how do we know when one side is running out of steam?
Think about it like a timeline. In a downtrend, a massive red candle forms first. Then the next red candle is a bit smaller. And then a tiny, shrinking red candle forms. These shrinking candles are basically screaming at us that the sellers are losing their energy. Initially, a ton of people were selling, but now hardly anyone is. This is a massive sign of exhaustion and a major warning of a potential trend reversal.
Beyond just shrinking candles, a sudden change in color is another huge visual cue. Imagine seeing 4 or 5 consecutive red candles. The sellers are completely exhausted, and then suddenly, boom, a massive green candle appears. This means exactly where the sellers were weakening, the buyers launched a surprise attack. Or, if you spot a massive momentum candle that completely swallows the previous 3 or 4 candles, that is your textbook signal of a total power shift.
Let's dive into part 4, inside and engulfing patterns. These are specific 2-candle formations that show a complete transfer of power.
Let's compare them side by side. In an inside bar, imagine a small green candle forms right after a large red candle, staying entirely inside the red candle's body. This means the downtrend's momentum has completely paused. The sellers lost their strength and just couldn't create a new low. On the flip side, we have the engulfing pattern. Here, a red candle is followed by a green candle so large that it completely swallows or engulfs the old red candle. That isn't just a pause in momentum. That's the buyers aggressively taking total control of the territory.
And now, part 5,
The golden rules of trading. Because let's be real, just spotting these shapes is absolutely not enough.
If you actually want to trade, you have to follow this core mantra. Never, and I mean literally never, trade a pattern you spot randomly in the middle of a chart. These candlestick patterns only work when they form at support, which is where price has bounced up before, or resistance, where price has dropped before. Support and resistance are the only valid battlegrounds to look for patterns. A pattern floating in the middle of nowhere, it means absolutely nothing.
Look at the difference between an amateur and a smart trader. The amateur trades on pure greed. The second they see a long wick candle at support, they buy immediately. The result? The next candle drops and they get stopped out. But the smart trader? They're patient. After that long wick forms, they wait for the very next candle. When the next green candle closes above the previous one, they enter with confirmation. Remember, you aren't rewarded for rushing and trading, you are rewarded for confirmation.
And that brings us to the rule of 3. This is a reminder to always check multiple time frames. If you're trading purely based on a 5-minute chart, your signals won't be that great. But if that exact same pattern is showing up on the 15-minute, the 1-hour, and the daily chart, the chances of your trade succeeding just multiplied exponentially. Larger time frames give you significantly better accuracy.
So let's rapidly recap these 4 non-negotiable rules so they really stick. Number 1, only trade at support or resistance. Number 2, always wait for the next candle's confirmation. Number 3, check higher time frames for the bigger picture. And number 4, absolutely the most crucial of all, always use a stop loss. Look, patterns aren't going to work 100% of the time, so strictly limiting your risk is the only way you survive in this market.
Ultimately, true trading power doesn't come from memorizing shapes. It comes from deeply understanding the psychology of the battlefield. When you start seeing this ongoing fight between buyers and sellers, every single red and green candle is going to start speaking directly to you. So ask yourself, do you want to be a trader who just memorizes, or a master who actually reads the market's mind? Are you ready to decode your next chart?